Brad Williams, Frugal Finance, duration-based hedging using futures. Well, we briefly touched on duration, so let's see what it looks like in practice. In a scenario where you have an asset position sensitive to interest rates like bond portfolio or a money market security, and you're looking to hedge it, you might consider using an interest rate futures contract. Well, that's why interest rate future contracts are out there. Why would you do this? Well, let's first and foremost define the futures contract. F, the contract price for the interest rate futures contract. Duration of the asset underlying the futures contract at the maturity of the futures contract. Remember, we computed Macaulay's duration. We can do the same thing here. P is the forward value of the portfolio hedged at maturity, generally assumed to be the same value of the portfolio today. The forward value, remember? We're going to look at some forward stuff here. Duration of the portfolio at the maturity of the hedge. So we have duration of the asset underlying the futures contract at the maturity of the futures contract, and duration of the portfolio at the maturity of the hedge. The different tools. If we assume that the change in the yield, delta Y, is the same for all maturities, which means that only parallel shifts in the yield curve can occur, it is approximately true that the change in P is equal to negative PD and E to the change of Y. It is also approximately true that the change in F, contract price, is equal to the contract price, duration, and Y. The number, if contracts required to hedge against a certain A of Y, therefore is N of 1 equal to forward value times D, duration, divided by F, contract price, D. This is the duration-based hedge ratio. It is often called the price sensitivity hedge ratio. Putting it in place turns the duration of the entire position 0. If you're using a treasury bond futures contract as your hedging instrument, you'll need to base your decision on an assumption that a specific bond will be delivered. This entails estimating which available bond is likely to be the cheapest to deliver when you initiate the hedge. This is very technical. However, if the interest rate environment shifts later on, making it seem like a different bond will be the cheapest to deliver, you'll have to adjust your hedge accordingly. This adjustment might lead to the hedge performing worse than expected. When the hedges are constructed using interest rate futures, it is important to keep in mind that interest rates and future prices move in opposite direction. Interest rates and prices. If interest rates move higher and interest rates and future prices go down. If interest rates move lower, the reverse happens and interest rate future prices go up. This right here, this should just say future prices go down. All right. If interest rates move higher, future prices go down. It doesn't say and interest rates. They don't work in conjunction. This needs to be deleted. And it should say if interest rates move higher, future prices go down. If interest rates move lower, interest rates go higher. Thus, a company in a position to lose money if interest rates drop should hedge by taking a long futures position. So similarly, a company in a position to lose money if interest rates rise should hedge by taking a short futures position. The hedger aims to select a futures contract where the duration of the underlying asset closely matches the duration of the assets they're hedging. Typically, euro-dollar futures are employed for short-term interest rate exposures, while treasury bonds and treasury note future contracts are preferred for longer-term rate exposures. On August 2nd, a fund manager with $10 million invested in government bonds, concerned that interest rates are expected to be highly volatile over the next 3 months. What does that mean? Does that mean volatility will average out to where the purchase price are equal? That's a tough question to even pose, all right? Well, high volatility, which way? And if it's highly volatile, what's been the average bond price? Fund manager decides to use December T-bond future contracts to hedge the value of the portfolio. The current future price is 93.02. That's 2 30-seconds. So 93.0625, because each contract is for the delivery of 100,000 face value of bonds, the future contract is 93.06250. Suppose that the duration of the bond portfolio in 3 months will be 6.8 years. The cheapest to deliver bond in the T-bond contract is expected to be 20-year, 12% per annum coupon bond. The yield on the bond is currently 8.8% per annum, and the duration will be 9.2 years at maturity of the futures contract. The fund manager needs to take a short position in T-bond futures to hedge the bond portfolio. Interest rates rise, there will be a gain on the short futures position, but a loss on the bond portfolio. Conversely, if interest rates fall, there will be a loss on the short position, but a gain on the bond portfolio. The number of bond future contracts to be shorted will be calculated using the equation above. 10 million divided by 90362 times 6.8 divided by 920 equals 79.42. To the nearest whole number, the portfolio manager should short 79 contracts. I give you a preview of what's to come. Everything here is new. Everything, for the most part. You know bond pricing and yields and what have you. But you're looking at duration. You're looking at delivery. You're looking at the best position and cheapest to deliver. As I said before, be patient. I'll explain it all as we move forward. Brad Williams, Frugal Finance. Thanks for watching.